What's going on, guys? It's Krytonite, and today we're diving into the world of crypto passive income. Specifically, we're tackling the age-old battle mining versus staking. Both of these let you earn rewards, but they go about it in totally different ways. So, the big question is, which one actually puts more money in your pocket? That's what we're going to break down today. We'll look at how mining and staking actually work, the good and the bad of each, the best cryptos for each method, how much you can realistically earn, and the risks involved. And make sure you stick around until the end, because I'm going to let you in on a lesser-known staking method that's actually beating out both traditional staking and even mining when it comes to profits. But before we dive in, make sure to hit that subscribe button and click the bell icon. Alright, let's jump in. So, let's start with the OG crypto mining. This has been around since Bitcoin first hit the scene back in 2009, and it's become a whole industry in itself. Basically, mining is like being the accountant for a blockchain network. You're using your computer's processing power to verify transactions and make sure everything adds up. Think of it like solving a really complex math problem. Miners are all racing to be the first one to crack the code, and whoever wins gets rewarded with, you guessed it, cryptocurrency. It's like a digital gold rush, but instead of pickaxes and shovels, you're using computer hardware. The process is actually pretty intensive, and it requires some specialized equipment. Nowadays, if you want to stand a chance of mining Bitcoin, you need some serious hardware. We're talking about ASIC miners, which are basically purpose-built machines designed specifically for mining. Alright, so we've talked about how mining can be your ticket to crypto riches, but let's get real for a second. This isn't some get-rich-quick scheme. Mining comes with its own set of costs, and it's not always sunshine and rainbows. There are several factors you need to consider before diving in. First off, let's talk about the elephant in the room, hardware costs. Like I mentioned earlier, those ASIC miners don't come cheap. They can set you back thousands of dollars. You're looking at a significant investment upfront, and that's before you even factor in electricity. And speaking of electricity, this is where things can get really expensive. Mining is incredibly energy intensive. Those computers are running 24/7, crunching numbers and generating a ton of heat. This constant operation means a continuous draw on electricity. We're talking about hundreds of dollars in electricity bills every month, maybe even more depending on where you live and how many rigs you're running. In some areas, the cost can be prohibitive. Then you've got cooling costs. All that heat from the mining rigs needs to go somewhere, so you're going to need industrial strength fans or even a dedicated cooling system to keep everything from overheating. This adds another layer of expense. And let's not forget about maintenance. Just like any other piece of machinery, mining rigs can break down, and when they do, you need to be ready to shell out for repairs or replacements. This can be both time-consuming and costly. The profitability of mining depends on a bunch of factors, like the price of Bitcoin, the cost of electricity in your area, how difficult it is to mine a block, and how efficient your mining hardware is. All these variables can make or break your mining venture. Realistically, for most people just starting out, mining Bitcoin might not be the best bet anymore. The competition is fierce, and the costs can outweigh the benefits. However, that doesn't mean mining is dead. There are still opportunities out there. There are still plenty of other cryptocurrencies out there called altcoins that can be mined profitably. These altcoins often have lower entry costs and can be a good starting point for new miners. Alright, so we've covered mining. Now let's move on to the new kid on the block. Crypto staking. This is a different approach to earning rewards, and it's becoming increasingly popular as more and more people get into crypto. In the simplest terms, staking is like putting your crypto to work for you. Instead of just letting it sit idle in your wallet, you're actively participating in the network and getting rewarded for it. But how does it actually work? Well, it all comes down to something called proof of stake, or POS for short. This is a consensus mechanism that some blockchains use to verify transactions and secure the network. With proof of stake, instead of miners using their computing power to solve complex problems, validators are chosen to validate transactions based on how much cryptocurrency they have staked or locked up in the network. The more cryptocurrency a validator stakes, the higher their chances of being chosen to validate a block and earn rewards. The beauty of staking is that it's way more accessible than mining. You don't need any fancy hardware or technical expertise. All you need is a crypto wallet that supports staking and some cryptocurrency to stake. Now you're probably wondering, okay, staking sounds great and all, but how much money can I actually make from it? Is it really worth the effort and the wait? Well, just like with mining, The profitability of staking depends on a few different factors. It's not a one-size-fits-all scenario. The main one is the annual percentage yield, or APY, which is basically the interest rate you earn on your staked coins. This is a crucial metric to understand. Different cryptocurrencies offer different APYs, and they can fluctuate depending on market conditions. Market volatility plays a significant role here. Generally speaking, you can expect to earn anywhere from 4 to 10% APY on average, but some platforms offer even higher rates. These rates can be enticing. To put that into perspective, let's say you stake $10,000 worth of a cryptocurrency that offers a 5% APY. This is a common scenario for many investors. After a year, you'd earn $500 in staking rewards. This is a straightforward calculation, but it highlights the potential gains. But here's the catch: to earn those sweet staking rewards, you usually need to lock up your coins for a certain period of time. This is a commitment you need to be aware of. This is called the locking or bonding period, and it can vary depending on the specific cryptocurrency. Each coin has its own rules and timelines. Some cryptocurrencies might only require you to lock up your coins for a few days or weeks, while others might require you to lock them up for months or even years. The duration can significantly impact your liquidity. This can actually be beneficial because it encourages long-term holding and reduces market volatility. Long-term holding can stabilize the market and potentially increase your returns. Overall though, staking is a relatively low-cost way to earn passive income in the crypto world. It's an attractive option for many investors. You don't have to worry about buying expensive hardware or paying exorbitant electricity bills. This makes staking accessible to a wider audience. All you need is some cryptocurrency and a little bit of patience. With the right approach, staking can be a rewarding experience. And if you want to stay updated with the latest in crypto news and never miss out on amazing opportunities, make sure to subscribe to our channel now. Alright, so we've covered the ins and outs of both mining and staking. Now let's get down to the nitty-gritty. Which one is actually more profitable? Well, as with most things in life, there's no easy answer. It really depends on your individual circumstances and risk tolerance. Mining can potentially generate higher rewards, but it also comes with significantly higher risks and costs. Staking offers a more predictable and passive income stream with lower risks. So it really comes down to your personal preferences. Ultimately, the best way to decide which option is right for you is to do your research, weigh the pros and cons, and choose the method that aligns best with your overall investment strategy and financial goals. Now, for those of you who stuck around, I'm going to let you in on a little secret liquid staking. This is a newer concept in the world of crypto, but it's quickly gaining popularity because it offers the best of both worlds: high potential returns and flexibility. Imagine being able to earn rewards without having to lock up your assets for a long period. See, traditional staking, while great, has one major drawback: your assets are locked up. This means you can't access or use them until the staking period is over, which can be quite limiting. That's where liquid staking comes in. It offers a solution to this problem by allowing you to keep your assets liquid. It lets you earn staking rewards while still being able to use your crypto in other decentralized finance, or DeFi applications. This means you can maximize the utility of your assets. You get the benefits of staking those sweet passive income rewards, but you also get to keep your liquidity and participate in other DeFi protocols. This dual benefit is what makes liquid staking so attractive. One of the most popular ways to do liquid staking is through platforms like Lido, Rocket Pool, and Anchor. These platforms have made it easy and accessible for anyone to get started. They allow you to stake your ETH and receive a liquid, tradable token that represents your staked ETH. This token can then be used in various DeFi activities. This means you can still earn staking rewards while simultaneously using your staked ETH as collateral for loans, providing liquidity to DeFi protocols, or even just trading it on decentralized exchanges. The possibilities are vast. In terms of profitability, liquid staking often outperforms both traditional staking and mining. This is because it leverages multiple income streams. This is because you're earning rewards from multiple sources: staking rewards and DeFi yields. By diversifying your income streams, you can achieve higher returns. By combining these strategies, you can significantly increase your overall returns compared to just holding your ETH or staking it traditionally. Liquid staking is truly a game changer in the crypto world. So there you have it guys, the lowdown on mining versus staking in 2024. It's a tough battle, but hopefully, now you've got a better understanding of how each one works, and which one might be the right fit for you. If you're all about that high-risk, high-reward life, and you don't mind shelling out some cash up front for hardware and dealing with the ongoing costs, then mining might still be worth it, especially for those altcoins. But if you're more into consistent passive income without the hassle and expense of mining, then staking is probably the better play. And if you want to take your crypto earnings to the next level, definitely look into liquid staking. So which one are you, team mining, team staking, or team liquid staking? Let me know in the comments down below. And don't forget to subscribe to Krytonite for more crypto deep dives and passive income strategies. Keep crushing it.